A warm welcome to all our esteemed clients and partners to the Maybank Private Media Market Outlook event. This year, the investment outlook has improved despite some of the hiccups along the way. Interest rates are close to peaking, and we're witnessing global economies holding up. With global markets regaining their footing, the prospect for investors have brightened considerably. It fills me with immense pride as well to share that Maybank Private has been awarded the prestigious Best Private Bank in Southeast Asia by Global Private Banking Innovation Awards and Wealth Briefing Asia this year. Thank you for your trust in Maybank Private. Together, we shall continue to grow and prosper and forge even stronger connections that propel us towards a more secure and brighter future. Thank you, and hope you enjoy the rest of the evening.
So before we begin the seminar proper, I would just like to do a short poll to gauge the sentiments on the ground. So if you could, take your phone out, scan the QR code on screen, as well as the QR code in front of the menu. So very simply, where should I be investing my money for the rest of the year? Could it be bonds? Maybe because interest rates are coming down, bond prices are going up. Stocks because of maybe China reopening, AI boosting productivity. Alternative investments such as gold, cash funds, micro lending, etc. And lastly, cash because your banker is giving you a very good rates for the time deposits. About 40-50% of you actually chose bonds, and about 30% actually chose stocks. Okay, moving on to question 2. So what is the biggest risk to markets? Joe, you have geopolitical, be it your US-China chip wars or the China-Taiwan Straits tension, corporate earnings disappointment, earnings growth, sales coming down, interest rate going up, or commercial real estate because all of us are working, most of us are working from home right now, values are coming down, or sticky inflation. That means that the Fed will continue to increase interest rates. So about 50% of us actually thinks that geopolitical risk will be the key risk for the rest of the year. Without further ado, I would like to invite our first speaker of tonight. He's none other than our Mr. Eddie Loh, Chief Investment Officer for Maybank Group Wealth Management.
But because of the lingering uncertainties, we do need to continue to seek quality investments amidst uncertainties. So within equities, we see better risk reward in Asia, be it in China or overall dividend plays. And within US, Europe, I think there's a need to diversify beyond tech, be more selective in tech, and also broaden beyond tech to some of the laggard sectors. And on the fixed income side, really focus on the quality bonds to achieve steady income, be it in US treasuries or be it in some investment grade bonds, right? Which could include some of the quasi-sovereigns in Asia as well as the higher tier financial bonds, be it the seniors or the tier 2s, right? And last but not least, do consider having some exposure in commodity related stocks or ETFs to hedge against some of these geopolitical and weather risks or climate risks that I talked about.
Now, for the second speaker, it's our pleasure to have Mr. Nigel Fu, Head of Asian Fixed Income from First Sentier Investors, as our second speaker for tonight.
Valuation aside, another reason why we like Asian investment grade bonds is the stability of their credit fundamentals. You can see from these 4 charts, these are the key measures of credit quality. Over the past 10 years, these numbers has been very stable. So in summary, despite a very gloomy and uncertain outlook, we do think that this is a very interesting time to invest in Asian investment grade bonds.
Next is the panel discussion. So once again, if you have questions for our panelists tonight, do keep them coming. Use the Pigeonhole app and submit your questions. So now may I invite the panelists up on stage.
I'll start with Harbin first, right? I think there were talks about, one of the reasons behind the resilient economy is because of this excess savings that have been built up. I think Nigel talked a little bit about that. But could you elaborate a little bit more about this excess savings and really how much of it is left to cushion the economy?
So I think this point was made out by Nigel as well, but you can see from the chart, I mean, during the lockdowns, we were all stuck at home. So I think you really had no choice but to save. And I think this chart kind of illustrated the spike in the huge amount of savings during the pandemic. And for Americans, two over years, you can see we estimated about 2.3 trillion that was essentially accumulated. Same phenomenon in China, but the fiscal transfers were a lot larger in the US. The government's a lot more generous with the handouts. So the cumulative savings is much larger. Americans have been drawing down on savings. We estimate about 1.4 trillion has been drawn down.
We switch gear a little bit to currencies, Andy. Well, there's a question here also, but can we talk a little bit about the dollar trajectory, be it in the short term and also the longer term?
So I think in terms of dollar trajectory, we need to look at it in terms of weeks or days. I think we need to get it in two things. First, I think the data dynamics that comes out on a daily basis, on a weekly basis. Second is what we look at from the strategy side and on the trading side is the policy reaction function of central banks. Our view is for the next few months or so, I think dollar support will be there. But we are expecting dollar to actually start to mildly soften towards the end of the year, partly because of a few things. Positioning, one, positioning is somewhat neutral now, and we expect some of the positioning to actually soften sell-off in the dollar towards the end. And secondly, I think we're trying to price in some expectations that the Fed would start cutting or reducing or pause maybe in the first half of 2024, but markets tend to actually price that in early. And when that happens, dollar tends to soften.
Okay, Eric,
Yes.
maybe you can tell us a little bit about MicroConnect, and also I think in particular about this huge potential of this micro business financing that you guys are looking at within China.
MicroConnect was actually founded by Mr. Charles Lee, who had been the Hong Kong Exchange CEO for 11 years. You look at the slide, the financing gap for small micro businesses is actually nearly $1 trillion. The blue ocean that you should think about is on your right-hand side, 70 million micro SME businesses in China, and this is the blue ocean whereby MicroConnect looks to tap and invest for you. Another key statistics I could share is that digitization of payment. We're able to reinvest in these franchises every day, mainly because of the digitization of payment. In the next slide, you would have seen how exactly do we do it. Basically, I think clients nowadays on three things. One, they want a strategy that are relatively liquid. So we target sort of a 1 year lockup type of strategy. Two, they want to have a decent high teens, 15% type of return, I believe. Three, you want a relative transparency.
Staying on China, I want to direct this question. I've got actually quite a few questions on China now on bonds. So I want to direct this to Nigel. Right, what is your opinion of the property sector in China and investing in the bond space?
Okay, at this moment, I'm not about to turn positive in terms of the sector at this moment. I do need to see the pre-sales numbers to recover and recover in a sustainable basis. At this moment, I think, I will still focus on the state-owned enterprise that has got stronger government backing. Go for quality. Once you see a sustained recovery in pre-sales, which will take time, then it's the time to get a little bit more active.
I think there's a question on everybody's mind. Is Singapore going to enter into a recession?
We're going to go into a recession, but it'll probably be a shallow recession, and it's going to feel a bit odd because it's not going to be a normal recession. That's my take.
Andy, question on gold. Where do you see gold now? I mean, we've seen gold hitting 2,000 and then now it's retreated. Do you see it revisiting that $2,000 per ounce level again?
And I think we highlighted that gold would reach that 2,000 level, 1,900 to 2,000 and slightly move beyond 2,000 for a while. Our level that we're looking at is probably 1,950 and slightly above that. It could overshoot slightly above that over the next 3 to 6 months, but I don't think it will be a slow trickle.
Just curious, I think, Eric, because you guys are actually investing in all the micro businesses, right?
Yes.
And we read about this weakening, very weak consumer confidence. Do you get the same sense actually from
Yeah.
the businesses that you are investing in?
I'm looking at my notes now. A few factors. Do circulation policy. I think that would be an interesting policy to look at. Number two, fast rising of middle class.
Right.
So if you look at all that, it's actually quite stable. If you look at the right stable consumption,
Okay.
it's actually bring us very, very good micro connect yield
Okay.
on a daily basis.
Before I wrap up the session, Nigel, I think why does it make sense for any investor in here to invest in the Asian IG fund?
I think the key points would be the fundamentals remain very solid across Asian investment grade, and that is the type of quality that you need, especially as we head into a potentially downturn, whether it's China or whether it's global economy.
Is AI a bubble now? Which aspects? How do you invest in AI? We are wary of pockets of excessive valuation, right? So we do need to be a bit more selective. And when it comes to investing in AI, it's not just about investing in AI chip makers, right? It's about the entire value chain. AI chips, AI infrastructure, applications, and also AI adopters, right? So we are actually at this juncture also looking for the early AI adopters, those that can successfully use AI to improve their profitability. I think that will be an area to look out for because I don't think the markets have actually focused in this area as well. So do watch out more on this front from our side. All right. I think that wraps up the panel session. I think it was an interesting discussion. Thank you very much for all your inputs. If there are further questions, do reach out to your RMs and we'll be happy to address them as well. So thank you very much, gentlemen, for your inputs.
Thank you again for joining us, both virtually as well as physically. I do hope that this session has provided you with very valuable insights. Last but not least, do enjoy the rest of the evening. Thank you so much.